Hello, Chris. Great to have you here. What is so valuable the Elliott wave principle?
The Elliott wave principle allows us to anticipate market moves. I think most methodologies or indicators or tool sets are based on reactions. They tell us that something's happened and they tell us to react to it. The Elliott wave principle often lets us know what's going to happen before it happens, and you can anticipate and you can be prepared. And I think the market participants who are anticipating things are generally ahead of the market participants who are reacting, and they're a step or two behind.
So what time frame is best for using Elliott wave analysis?
The analysis is effective on all time frames. The key is to knowing what time frame meets your own goals and objectives, and then looking at the appropriate charts, whether they're long-term charts, intermediate-term charts, or short-term charts for investors, traders, or those in between.
For many commodity investors, the last 4 years have felt like a bad dream. So in your point of view, does the Fed can stop slide of commodity markets? So how Elliott wave theorists identify the commodity markets?
The long-term decline in worldwide commodities is ongoing. It's not completed yet, and there's more to come, we think. And it's not just commodities, but the currency markets, which are obviously reacting to that. And so until we see the Elliott wave patterns complete, until we see the types of selling climaxes in commodities that signal a lasting low, where you really get panic selling to flush out losing positions. Until that happens, there's more to come. Well, no, they can't. They're certainly trying, but the good example is Japan. Japan has been trying to create inflation for 25 years, and they've been unsuccessful. And now the Fed is trying to do the same thing, to create inflation, and it's just not working, as we can see, with the lackluster moves in price indexes and the declines in commodities. So governments are ineffective in trying to manipulate markets long term. Oil's been consolidating sideways after its sharp decline earlier this year, and I see there's a real ceiling around $47 level, and so any rally up to there probably stops around 47, and then ultimately, following this consolidation, the sideways, we should see a renewed decline before a more lasting bottom occurs.
What strategies do you recommend play on recent volatile market?
Well, volatility means very different things for investors versus traders. Volatility is a bad word for investors. It signals instability and uncertainty, and those are never a good climate to invest in. On the other hand, traders like volatility. Volatility means sharp moves. It means profitable opportunities in either direction if you're prepared to anticipate those moves.
The PMI data indicated China's economic slowing down. So what's your opinion in China's stock market in short term and long term? So does China's economy will affect the U.S. financial market?
Well, the Shanghai Composite has been moving sideways for about a month now, and it's forming what Elliott wave we call a fourth wave contracting triangle. This is a continuation pattern. It occurs in the middle of a move. So we still need to do a fifth wave decline once this triangle completes, and then at that point we can perhaps make a more lasting bottom and get some type of a larger rally to move in the Chinese market. I don't think the Chinese economy has had a big effect on the U.S. market in the past, but that may change with additional devaluation in the Chinese currency, the yuan. If that occurs, and I think the American market is somewhat concerned about that, a falling yuan, then we will see deflation exported to the U.S. and probably some instability in the U.S. market.